Welcome back. Jeremiah and I are talking about required minimum distributions and the variances and how do you take them, but also how to, what we want to talk about now in this segment is talk about the tax ramifications. How can you reduce it? And under the current laws, they eliminated the stretch provision. In other words, to be able to stretch out the distribution, the required minimum distributions to your children and or other heirs over their lifetime. And the law that was passed in 2009 said, nope, you got to take it out over a 10-year period. So that changes the distribution pattern for very wealthy clients. So let's kind of talk about that. I mean, there's ways that you can deal with that.
Yeah, 2019, they changed the laws. And as we go forward, the idea that you're just going to keep this money generationally is different. And so you kind of need to use it, or you'll know your kids are going to use it within 10 years. So one that comes up is if someone's charitably minded, you can use some of these things for charities. So they call it a qualified charitable distribution.
Yeah, we refer to it as a QCD.
QCD, qualified charitable distribution.
Right.
So it's a distribution coming out of your retirement accounts, whether it's an IRA or 401k. It comes out, but instead of going into your pocket, it goes into a charity and you direct where it goes.
Right.
And the benefit of that is you skip out on having to count that as your income. So for AGI, for all those items that you could bump you up for your taxes, it just gets skipped.
So the advantage, just so that our listeners understand, the advantage of doing a QCD, a qualified charitable deduction, is that you are reducing your, and I don't want to get too technical here, but it's called your IRMA, but it's basically your modified adjusted gross income. And again, I don't want to get too technical here, but it's how the government determines your premium for Medicare.
Yeah.
So if you can drop your income on that first page down to another segment, you drop into another threshold. We looked at it for a client. If they dropped into the next segment, it would save them about $2,400 a year in premium, but it would have cost them $60,000 in charitable giving to get down there. And they looked at me and said, no, I think that's too heavy of a price for $2,400.
Right.
But for people that are making good money, what they're recognizing, I mean, if you're at a party and somebody says, I'm paying $170 a month for my Medicare, that kind of tells you what their income is. But if somebody says, kind of is real quiet and say, no, I'm paying like $450 a month, that also tells you where their income, because there's brackets. As your income goes higher, you pay more for your Social Security.
Yeah.
So again, you can do a charitable, you can do a QCD and reduce your income if it's reasonable.
Yeah, and for folks who are not charitably minded, it doesn't make a whole lot of difference.
Right.
If someone's going to be giving anyways, they say, I care about these causes, I care about this aspect of my community, I want to be giving these amounts. It's now becomes strategic of how you do it. Do you give it out of your bank account? Do you give it out of some stocks you have? Do you give it out of your RMD? And the benefit of giving it out of your RMD is it lowers, basically your AGI, which impacts a lot of things. So how you do it is basically you communicate with the plan that you're working with, that it's going to go directly to the charity. It can't come through you and go to them. It has to go directly over.
Right.
You can do it up to $100,000. An interesting tidbit, we're just talking about this, is it used to be 70 when you had to take your RMDs. Now it's pushed to 72. It used to be 70.5 when you could take a QCD. It's still 70.5 when you could take a QCD.
Yes, they didn't line up together as they moved it.
Which is just odd. I don't know that people.
Well, that's the IRS. I mean, come on.
I know that people wouldn't necessarily take it early, but you could. You could take it at 70.5. Don't forget your half. But 70.5, you can start taking these qualified charitable distributions that go directly to a charity. Skip out of your income. And that's a tax planning way to say, I was going to give anyways. Instead of giving out of these accounts, I'm going to give out of this account and avoid.
Yeah, and I think again, just taking your straight RMDs, if you've not done some tax planning, for some people, this is really critical. I mean, tax planning is really important on how you take this money, what you do with it. And some people who want to keep their wealth, in other words, when they pass away, they want to make sure that the total value of their account is going to pass on to their children, and they want to get their tax free. Well, there's some strategies to do that. Now, one of them is to buy life insurance. This is kind of it's not a common, but for people that are what I consider high net worth and they want to retain the value of their assets, so what they do is they insure it.
Yeah.
And by taking some of the distributions to buy a life insurance policy, and it has to be like a whole life or an adjustable life
something
policy.
That won't term out or end. Something that goes to the whole life. Yep.
And you can buy this life insurance provided that you can qualify for it. You find a company that'll write it, maybe sometimes more than one. But when you die, life insurance proceeds are tax-free. and you still may have some residual distributions that would be taxable to your heirs, but you're getting a lump sum to your heirs of whatever dollar amount you're insuring for it. And the thing that most people need to recognize is that life insurance is tax-free.
Yep.
It's not subject to income tax.
Yeah, the way people do this, I mean, you think of someone who's 75 getting a whole life insurance policy. Those are going to be high premiums. I mean, they might be $20,000 as a premium. And so it's significant amount of money going into this plan. But the idea being when they pass away, you've converted maybe $1 million in one bucket that's going to be taxable. You pay some taxes on it, you get it into life insurance, and then you receive, the family at your death receives $1 million tax-free. So you kind of transition from one to another. For a lot of people, this doesn't make sense. They're not going to pay $20,000 in premiums as they go forward.
Right.
However, for some, it's
some
useful.
people that have an abundance of wealth and they're trying to retain that wealth within the family and trying to figure out how to navigate around the tax ramifications. Another one is setting up beneficiaries that would be in a trust.
Yeah.
And we've talked about this, like a charitable remainder trust.
Charitable trust, right?
It's a really interesting concept. I think there's a lot of planning that has to be done.
A lot of it, you need some good counsel on this one to get these set up. But there's a charitable remainder trust,
right?
Which means you dedicate some asset, some amount of money to a charity. You receive the income stream.
Now, this is not, well, you're still alive. We're not worried about it. So if you're still alive and receiving your RMDs, you're receiving your distributions, this is at the time of death. So this is at time of death, you would name as a contingent beneficiary, not your spouse, but you're trying to get this money to your kids eventually. So you would name the children, not the children, but the CRT as the contingent, right?
Yeah. So usually the benefit is you get streams of payment for a while, and then eventually the asset, whatever's left, goes to the charity.
Right.
To make the reverse of that is that the charitable lead trust, where you're giving the assets, the income to the charity, and at the end, the asset comes back to the family.
So what triggers it is the death of the beneficiary. So on a charitable remainder trust, if you're naming very young beneficiaries, you don't get a lot of tax write-off, but you have a stream of income that could last for 30, 40 years.
Yeah.
And eventually when the final beneficiary dies, the charity is going to get whatever the residual amount is. Yeah. But it could be a way in which to get money to the beneficiaries. Yeah. And what you're doing is you're sidestepping that 10-year distribution requirement, on non-spouse beneficiaries.
Right.
I guess what we're getting down to is that you got to plan for this. Yep. This is not something you just wake up one day and hit the button. It's going to happen, right?
And stumble here. There's a few layers of this. Of some people just want to save enough for retirement. Other people want to save enough for a comfortable retirement. We're talking about people who have saved enough. They've done well. They've done all the things they're supposed to do. But now, if they just, like you said, wake up one morning, they're going to have more taxes than they ever thought they would. But there's just a bit of planning that you can really structure this well to get the life that you want. Pay reasonable taxes, but not overly paying taxes, and also perhaps fund the family or charities that matter to you. So it's a way of being strategic in your retirement years for folks who have enough and want to really think through the benefits here. And it's a lot of the people we work with, folks who they've done well, they have enough to be strategic about, and they can really benefit from thinking through a lot of these items.
Yeah, so if you're at a stage right now in your life where you're facing these, you have to be able to take required minimum distributions, I would suggest you give us a contact. Go to either call us on our phone, which is, call us on our phone, call us at our office, which is 951-684-7011, or simply go to our website, which is www.retirementunlimited.com. We'd be more than happy to help you navigate through some of these serious questions and get the best outcome for you.
Yeah. If you have any topics you'd like us to discuss, send us a message. If you missed any part of this radio episode, you can find us on YouTube.